The difference in currency values, like $1 equaling 83 Indian rupees, stems from several factors tied to the economic fundamentals of each country. At its core, currency value is driven by supply and demand dynamics. A currency that's in high demand or limited in supply generally holds more value. The United States dollar, for instance, is widely used and in demand globally, partly because it's the primary reserve currency held by most central banks around the world. This demand keeps the dollar's value high compared to other currencies. One major factor influencing currency values is a country's economic health. The United States has a large and diversified economy with a high GDP and robust industries, attracting foreign investment. India, while having a fast-growing economy, faces challenges like higher inflation, poverty, and trade deficits, which affect the demand and thus, the value of its currency. When investors perceive an economy as strong and stable, they are more likely to buy that country's currency, pushing up its value. Interest rates set by a country's central bank also play a significant role. When a country has high interest rates, foreign investors may seek to deposit money in that country to earn better returns. This increases demand for that currency, driving up its value. Conversely, lower interest rates tend to devalue a currency as investors look elsewhere for better returns. In the case of the US dollar, the Federal Reserve's policies directly impact the dollar's strength on the global market. Trade balances further affect currency value. Countries with a trade surplus exporting more than they import often see their currency appreciate, as there is more demand for it to pay for goods and services. A country like India, which has a trade deficit, importing more than it exports, may experience currency devaluation since it has to spend more on foreign currency to pay for imports. This ongoing demand for foreign currencies, such as the dollar, often keeps the rupee's value relatively lower. Inflation is another crucial factor. A country with low inflation usually has a stable currency value because the purchasing power remains relatively high. Higher inflation, on the other hand, erodes currency value as purchasing power diminishes. For instance, if inflation is significantly higher in India than in the United States, the rupee loses value faster than the dollar, resulting in a larger exchange rate gap over time. Central banks try to control inflation with policies, but persistent inflation can weaken a currency considerably. Political stability and government debt levels also influence currency values. Investors prefer politically stable countries with sound fiscal policies, as these reduce the risks associated with currency investment. Countries with high levels of public debt may have to print more money to manage that debt, leading to inflation and currency devaluation. The United States, despite its high debt, has remained politically stable and has a diversified economy, which has helped maintain confidence in the dollar. Finally, speculation in the foreign exchange market can cause fluctuations in currency values. Investors may buy or sell currencies based on anticipated economic changes, causing short-term volatility. When speculators believe a currency will strengthen, they buy it, increasing demand and value. Conversely, if they anticipate it will weaken, they sell it, which reduces demand and value. In summary, the difference in currency values, like the $1 to 83 Indian rupees example, is shaped by various economic factors including supply and demand, interest rates, trade balances, inflation, political stability, and market speculation. Each of these factors interacts in complex ways, creating the diverse currency values we see worldwide.